Our next lecture is on insurance principles. Insurance principles are classified into 6: utmost good faith, insurable interest, the first 2 being principles connected with underwriting, proximate cause, indemnity, subrogation, and contribution, the last 4 being associated with claims. Let us start with the first principle, that of utmost good faith. An insurance contract is different from a commercial contract in that a commercial contract is based on the maxim of caveat emptor. That means it is up to the buyer to be vigilant, to be aware of what is being traded. Unlike an insurance contract, which is based on uberrima fides, meaning utmost good faith, in which case both the contracting parties have a duty to disclose all information, whether this is asked for or not. In this case, the position of the contracting parties is different, especially since the underwriter is not viewing the risk most of the times, whereas the insured or the proposer is fully aware of the risk being forwarded for insurance purposes. The definition of the doctrine of utmost good faith is emergent from the classic court case of Roseanne versus Bowen, in which the judge defined utmost good faith as being a positive duty, voluntary, to disclose accurately and fully all facts material to the risk being proposed, whether requested or not. So, the duty of utmost good faith, as we said earlier, rests on both parties. Both the insurer and the insured or the proposer have a duty to disclose all material facts. We advise you to look up the case Carter versus Boehm, in which case material facts were explained by the presiding judge. Furthermore, a very important act, that of the Marine Insurance Act in 1906, defined, among other principles, the meaning of material facts, wherein it was said that a material fact is every circumstance which would influence the judgment of a prudent insurer in fixing the premium or determining whether the insurer will accept the risk, decline it, or accept it together with certain conditions. This slide displays some examples of those facts which need to be disclosed. This slide will list those facts which need not be disclosed and thus are not material. The duration of the duty of disclosure varies in that at common law, this duty of disclosing material facts lasts until the contract is formed, whereas in insurance the duty arises upon renewal and also is continuous during the currency of the contract. Therefore, this means that the insured is duty-bound to inform the insurer of any material facts introduced during the currency of the policy. In insurance, as opposed to commercial situations, A warranty is a very important undertaking. In fact, it is a promise which is guaranteed by the insured in that certain facts exist or do not exist, or certain actions will be performed by the insured or certain actions will not be performed. This will ensure that good management and housekeeping are guaranteed. If an insured breaches the duty of utmost good faith, it is said that the insured is either misrepresenting or not disclosing truthfully facts material to the risk. Misrepresentation and non-disclosure can be either innocent or fraudulent. In both cases, the insurer has a right to refuse the contract. In fact, if an insured is in breach of utmost good faith innocently, then the insurer can avoid the contract ab initio. In this case, the insurer would return the premium. However, if fraud is discovered, the insurer will of course avoid the contract and can also sue for damages. In this case, the insurer can keep the premium. Of course, the insurer reserves the right to ignore the breach and carry on with the contract. To ensure that the insurer is obtaining all facts relevant to the risk, direct questions are asked in a proposal form to determine such material information. In fact, the proposer is asked to declare the truthfulness of such statements made, as these material facts would be the basis of the contract. The next principle is insurable interest. The definition in this slide says it all. Insurable interest is a legally recognized financial relationship between the person effecting the contract, entering the contract, and that which is being insured. This, in simple terms, means that the insured must bear a financial relationship, must have an interest in that which is being insured. In marine insurance, it is enough to show that insurable interest existed at the time of loss. In life assurance, on the other hand, it is sufficient to show that insurable interest was present at inception. In other classes of insurance, insurable interest must exist both at the time of inception and when there is a loss claimable under the policy. Insurable interest may be created at common law, for example through ownership, under a contract in the case of landlord and tenant situations, or under statute if the law makes the insured responsible for certain affairs, typically liability. Here are some examples. In property insurance, one could hold insurable interest if there is part or joint ownership, or in the case of agents. Insurable interest also arises if there is liability, and in the case of life assurance, the most classic case is when there is a creditor-debtor relationship, in which case the creditor has an interest in the life of a debtor up to the amount of the loan.